today we're here to talk about sources of financing. And basically, pretty much, with the debt being so tight, what are the other sources? And with me, I have this wonderful panel of experts who hopefully they'll give us something to take home and something to help improve business. I have Ilaria Benucci, who's an investment director, equity investments at CDC Group. And I have Dr. Livingstone Biamungu, Chief Investment Officer with Development Bank of Rwanda. And finally, we have Mohamed Wade, founder and managing director of Mandla Capital. But I'm sure that introduction doesn't do you justice. So I'll let you introduce yourself and give us a bit of a background about your organizations and what you're doing. Ilaria?
Start first, yes. Good afternoon. So I'm an investment director in the equity division of CDC and leading the real estate efforts. CDC is the British government-owned development financial institutions, and we operate through three divisions, the one which is direct equity, again, the one I belong to, but we also have fund of funds and debt financing. Now, we have about $6 billion asset at the moment on our balance sheet, and our regional geographical focus is Sub-Saharan Africa and South Asia. South Asia is India, Pakistan, Bangladesh, Myanmar, and Nepal. Now, obviously, the development agenda as development impact, international development, not development of assets, is kind of top on our agenda, and therefore it's important to balance, obviously, some sort of commercial returns, but also with, again, an important development impact in the country and the creation of jobs and so on and so forth. Therefore, in the specific of the hotel sector, what we're looking at is mainly three-star hotels. We are interested in promoting interregional trade, and we believe that hotels in this respect, especially three-star hotels, are infrastructure, logistic infrastructure, and we are not particularly interested in looking at 4 or 5 stars because obviously that's a different perspective. So this is where we're coming from, and this is where our experience lies these days.
Mohamed?
I am Mohamed Wade. I'm the managing director of Mandla Capital. We're essentially an advisory shop, but we were dragged into doing a lot more by our clients who started asking us to help raise equity and actually inject equity directly because in a lot of hotel projects, sponsors bring land, some cash equity, which is typically not sufficient for lenders to come in. So basically, we support sponsors with additional equity. We also drive the development process, negotiations with operators, discussion with lenders, etc. We are based in Abidjan. We cover West Africa, with a big focus on Côte d'Ivoire and Senegal, but we'll also look at opportunities in Ghana and Guinea, Conakry.
Yeah. Good afternoon. My name is Dr. Livingstone Biamungu, and I'm the Chief Investment Officer for the Development Bank of Rwanda. The Development Bank of Rwanda was incorporated some 50 years ago. That was in 1967. And has been and only a development finance institution in the country. We are dealing in promoting development in the country, and currently we focus on specific sectors. These include agriculture, affordable housing, export, and in export, that's where we find hospitality, because this is foreign income earner. And then there is energy, there is education, and social infrastructure. The kind of work that we do is to provide both debt and equity and technical assistance. In this, specifically for the hotel industry, we have financed both debt and equity for most of the infrastructure within this country. And still, when it comes to debt and equity, we accompany the promoters by putting in equity. That means that we are trying to work together. And then when it comes to debt, that one is paid. Once you finish up the debt, then the hotel has taken up. Then we sell off our shares to other off-takers. So basically, that's what we do when it comes to the hotel industry.
Okay.
And so when we are talking about specifically on the source of finance, I'm here. I'm part of the source of finance. Thank you.
Okay, again, let's back to you, Dr. Livingstone. What would you say are the emerging opportunities, and what would be the sources that were not there traditionally?
In Rwanda, sometimes we do things differently. They are the traditional sources of finance, going to capital markets, institutional investors, etc. And actually, that is one of the major sources of finance. But something that is being done differently here is local investors putting their resources together, what we call collective investment schemes, such that probably you have seen when you look in the town, you will see malls coming up, big malls coming up. You find it's about 50 or 100 business people who have put their resources together, and then they can source other capital from elsewhere. So part of the source of capital is from within the local business community. And that one has really worked very hard. And for instance, now even for two hotels, there is one in the Western Province, Kivu Marina, and then there is another one in Eastern Province, which is called Epic. It is business people who who pulled resources up to 50% of the total investments, and then they look at other sources of finance from the capital markets, from the banks and other sources. Another emerging opportunity is some investors, really, the private equity investors, who come because they have known that there are business people who are in to do a business, then they come and join them. And in here, they are not bringing in capital, but they want to use some kind of approach like Islamic banking, Madaraba, something of the sort, such that this time around you don't pay interest, but you share the profits. Those are some of the emerging opportunities that are coming on the market here.
Okay,
Thank you.
Mohammed, just to pick up on that, what steps are being taken to improve access to long-term capital?
Well, one of the issues that, at least in West Africa, sponsors are faced with is the fact that local banks don't provide long maturities. So if you're building a hotel and not selling, of course, because it's a hotel, you need more time to pay the loan back and have a decent debt service coverage ratio. And local banks, for reasons of not being able to collect long-term savings from the market, have a hard time doing it. So the players you have to get long-term debt are the DFIs. I think CDC is definitely one of them. You have the IFCs and the Proparcos of the world who definitely are able to provide the hard currency, long maturities. And there's a big opportunity, I think, with the local institutional investors or regional institutional investors, insurance companies, pension funds, etc. They have a mandate with the funds they collect, to invest long-term, typically, because they have long-term obligations. The only issue is that hospitality real estate is as an asset class is very complex. You don't just buy or build a property and leave it there and it produces cash flows. You have to work on it. It's a service business. So institutional investors need asset managers. They need brands to make them comfortable investing in that asset class. So seeing a lot of international brands coming to Africa in general, and West Africa in particular, is probably helping in that respect. The other thing that can be done is definitely growing the asset management, the operational asset management business and skills in the region, and also having tax incentives. If you want to do a REIT, for instance, in most Francophone West African countries, actually the tax system works against you. So there are things that can be done to encourage institutional investors to get more into real estate in general, and especially hospitality real estate.
Okay. Ilaria, from your experience in the African market, what challenges have you seen are common, and what would be the possible solutions towards this?
First of all, I'm talking more here from equity perspective point of view. Perhaps then we can comment a bit on the debt financing, which is also something that the CDC does, but I'm more on the equity side. And I think there are, to say, attract institutional, international capital, or call it no-local, because I mean it's difficult to define it. I see two big challenges, and one I slightly disagree on the fact that international investors are attracted by not necessarily by brands. What do I mean by that? Is that it's quite difficult to, I mean, it's a fragmented local market, and therefore normally brands invest with one developer. And for someone like myself to just invest asset by asset equity is quite challenging. Once because it's also developing the relationship with each and every different developer. And secondly is also the question of how much is the minimum that you can deploy? Because I mean an investment of 5 million probably does make a lot of sense for someone which is managing money from abroad, say. So what we looked at, in our experience, we've been looking more at owner, developer, operators, which is not your international brand, but you have a sort of probably as a matter of fact, the opportunities that we've been looking at are more of this kind. Again, you control your development, you can scale up, you can go multi-countries, multi-cities, and so on and so forth. So that's one issue. So it's a bit fragmented. So what is the right solution? Because then the counter argument is then they become real estate heavy and they're not profitable enough. So big challenge there. Solution, I don't think there's one yet, because I mean it's still a relatively new market for institutional capital. The second one, equally relevant, is that the cycle doesn't work well with the private equity cycle, because I mean obviously the classic private equity would be a 5-6 years term holding and then obviously sell on to the market. I mean the markets are not liquid, and secondly, especially if you develop, you hear stories that go from, I mean, 8 years to get to stabilization to 20. These are exaggeration. The market is getting better, and I think that the industry is more professional, and there are things getting improving. However, you still have this issue about the long term. So at the end, it's true that even is people like myself that can hold for longer. So is it going to be, I mean, my holding is at least 10 years. And then you have more, probably the solution is to look, if they exist, to balance sheet money. So family offices and things like that, probably it's easier to get to invest into development, which is what we're talking about.
Okay, thank you. And just to pick up on the side on equity, Mohammed, what are the exit or liquidity options for investors looking at it from her side and her point of view?
Yeah, I'll answer that. I think Ilaria made a very good point that looking at having an asset-by-asset approach is probably not the best approach. And a portfolio approach, I think Westmont was on this stage earlier, and that's what they're doing. And also the company from Kenya is also working on several assets. I think definitely owner-operators are typically they need to build their brands, so they build several assets, but you could also have a portfolio approach, and that's the approach we're taking. So we're working with owners, doing joint ventures, not always easy, but we need to find the right balance, aligning interests. It's a lot of work, but we've been able to do it in a number of occasions. And then have a portfolio approach, and we can approach investors, equity, and actually even debt, and offer a portfolio which is diversified within a country or within a region, which makes it probably easier in terms of risk management. I think to encourage investors to come into real estate and hospitality real estate, exit is very important. So I think that's a very important point too. Ilaria was saying private equity players like to exit after 5, 6, 7 years. This is typically not the best timing for an asset like real estate, where you probably want to look at 10, 15 years. So there are more and more permanent capital vehicles that we see in other regions. We hope that there will be more of these in Africa, not so many right now. So the options are capital markets, not very liquid in our region, typically, at least West Africa, so it's a very theoretical option. You can put your shares back to the owners. Typically, if you're in a big city and you have prime land, it belongs to a wealthy family, a business family, and they may be able to use their balance sheet to raise the money to, after a number of years, to buy out an investor. And then you can get creative. I saw an example where the sponsor was doing service apartments, so some of the apartments were sold, which generates equity and cash, and you can use the cash to buy out some investors. So you have to get creative because the capital markets are not really helping.
Okay. Dr. Livingston, a bit on the positive side. From your organization, what are what you call the highlights of key achievements or success stories that you've seen?
Well, as I began saying, some of the success stories have been that we've been able to contribute massively to the development of the hotel industry in this country, and we are still continuing to do so. And this one, as I said, it's on the hotel construction, not only construction, but even the management when it comes to technical assistance. And two, our success is on the equity part that we contribute as a bank to accompany the investors. By law, we are not supposed to exceed 25% of the total shareholding. So we keep probably the lowest within the company management, but we accompany them until they succeed. But we are looking at the tourism sector in general, not only the hotel industry. Say for instance now, you heard about the Bugesera International Airport, which is being constructed now. The Development Bank of Rwanda is there, and it's coming together with other with other investors, really. So whenever we are in some kind of business, so it somehow we catalyze investments from other development finance institutions. Our money may be small, but when other DFIs, for instance, hear that BRD is within that type of project, they come and join us, and we feel that is part of the success. Secondly, when we are working with the projects, not all of them succeed straight away. But there are those ones that get challenges all through, but we look for mechanism of turning them around, restructuring. So all those ones, but at the end of the day, we see them succeeding, and that at the end of and therefore we feel that we are fulfilling our mandate as a development bank.
Okay, Larry, let's talk about leverage and what kind is available, and what do you feel, or rather would deem to be appropriate in this market?
A couple of considerations. First, a word of warnings. I was back in 2008. Very happily sitting on a portfolio of hotels which were leveraged quite high. And obviously, well, that was the way that you can make your returns and your IRR and so on and so forth. Then what happened in 2008 happened, and all of a sudden you're in breach on every possible covenant, especially your LTV, which goes over 100%. So how do you sit comfortable with leverage? I would say that the attitude has been changed. I mean, you don't see anymore this aggressive, even in what they call aggressive private equity funds in Africa, you don't have this super aggressive leverage. So that's so what is right? I mean, it's something, I think that what we're looking at right now is even on sort of stabilized assets. I haven't seen much than 60-65% on the loan to value, and probably is that where the market is, and there's not a lot of this financing available. Secondly, I heard again and again that one of the issues is the lack of that bank financing. However, you have to again make a difference between is it local financing or is it dollars financing, hard currency financing? Local financing is very expensive. So that is not going to be your panacea to get to the result that you want to get from, again, returns point of view. It's not going to be that helpful, because when you pay something like 8, 9, 10% on a development, probably your cost of equity is at the same level or even below. So it's an interesting question. The other one, if you borrow in FX or in hard currencies, then you have to consider the valuation. So who's going to take care of that? Who's going to take the risk of the valuation? So there's quite a lot of challenges. It is very true that at the end, you don't have long-term financing, and for that kind of financing is more getting the DFIs for the good or the bad. At least we are prepared to lend on longer terms. But again, it's not. I wouldn't just get to the conclusion that the leverage, additional leverage, a good leverage would sort out your problems, and therefore you have a perfectly profitable product. But it's not the case. You still have the challenge of a longer time to stabilize, and probably it's a question of getting people more comfortable with the same developer and the same sponsor, and probably know it better. What is the right balance, I would say.
Okay. At this point, I'd like to invite a question from our audience. Is there anyone with a question for this wonderful panel? No? Okay. Mohammed, as we close up, what would you say would be the key points that you want people to leave with from this conference?
I think that the issue of leverage that was and local currency versus hard currency is a very important one. Of course, if you take a 3, 4, 5% loan in hard currency, it looks cheaper than an 8, 9, 10% loan in local currency. But at the same time, if you have a 50% devaluation or the 30% devaluation, then it becomes a different story. So I think rather than looking at the cost, typically if you're in a efficient market, which doesn't mean much, the cost that you would pay in hard currency in terms of interest rate and the cost you will have on local currency will probably be, the difference will be the expectations of devaluation and inflation. So in theory, it's supposed to be the same. We know it's never the case, but it's supposed to be the same. The best way to look at it is probably to say, am I generating revenues in local currency? If I'm a 3-star hotel catering to the local or regional market, most probably my revenues are in local currency. And I'm probably better off then, even if it looks more expensive, taking a local currency loan and negotiating as best as you can and leveraging as little as you can. If you have 70% of your revenues in US dollars or euros, then you can go and get a hard currency loan without increasing the total risk of your project.
Okay. Ladies and gentlemen, thank you for the session and for taking us through what would be the other options, say, for what was there traditionally. And I think for the next session, where we'll be discussing DFIs, I think this was a good conversation to start with. Thank you.